Warning: what happened to silver in 1980 is about to happen again. There is a pattern playing out in the silver market right now that should stop every single person watching this video dead in their tracks. And I'm not saying that to be dramatic. I'm saying it because the data is undeniable. The historical parallel is almost eerie in how precisely it's lining up, and the people who understand what I'm about to show you have been quietly positioning themselves for what could be one of the most significant wealth transfer events in a generation. Let me ask you something. What if I told you that the most explosive silver price event in modern history, an event so violent, so sudden, and so devastating to those who were on the wrong side of it, left behind a fingerprint, a specific set of conditions that, when they appear again, have historically preceded a price explosion unlike anything ordinary investors ever see coming? And what if I told you that fingerprint is showing up right now in the silver market, with a clarity that has some of the most seasoned commodity analysts I've been studying quietly repositioning their entire portfolios? That's what this video is about. Because right now, silver is sitting around $68 an ounce. It peaked above $120 just a matter of months ago. And a lot of people looked at that pullback and said, okay, the silver story is over. The run is done, time to move on. But here's what those people don't understand. They're looking at the map upside down, and history is about to give them a very expensive lesson. To understand what's coming, you first have to understand what happened in 1980. And I don't mean the sanitized textbook version. I mean the full story, because the details matter enormously to what we're seeing unfold today. It starts with two brothers in Texas, Nelson Bunker Hunt and his brother William Herbert Hunt. These were not small-time speculators. The Hunt family was one of the wealthiest families in America, and Bunker Hunt in particular had a deep conviction that paper money was doomed. He believed the dollar was being inflated away, destroyed by reckless government spending and the severing of the gold standard just a decade earlier in 1971. And he looked at silver and saw what he considered the most undervalued asset on the planet. So, beginning in the mid-1970s, the Hunt brothers began buying silver. Not silver paper contracts, not ETF shares, actual physical silver, bars, lots of them. They accumulated silver positions that staggered the imagination, ultimately amassing somewhere in the neighborhood of a third of the world's entire available above-ground silver supply. They were stacking silver in vaults in Switzerland, in the United Kingdom, and they were standing for physical delivery on COMEX contracts, meaning when their contracts expired, they demanded the actual metal be delivered to them, not a cash settlement. And as they accumulated, the price began to move. In early 1979, silver was trading around $6 an ounce. Think about that, $6. By September of 1979, it had doubled. By November, it had tripled. By January of 1980, silver hit nearly $50 an ounce, a price increase of roughly 700% in under a year. In today's dollars, adjusted for inflation, that would be well over $100 an ounce. The entire financial establishment went into a panic. Silver was embedded in everything: photography, electronics, industrial processes. Jewelers were melting down silverware because the scrap value had exploded. Dentists were hoarding amalgam. Ordinary people who had inherited grandmother's silver candlesticks suddenly found themselves holding what felt like a fortune. And then the establishment did what the establishment always does when the rules start benefiting the wrong people. They changed the rules. COMEX, the exchange where silver futures were traded, suddenly announced that, effective immediately, traders could only close positions, not open new ones. They called it liquidation-only trading. Translation: if you were long silver, you could sell, but nobody new could buy. The game was rigged against the long side in the most naked, obvious way possible. And when that announcement hit the market, silver collapsed. $50 an ounce went to $10 in a matter of weeks. The Hunt brothers, who had borrowed heavily to finance their accumulation, faced margin calls they could not meet. By the end, they were effectively bankrupt. A family worth billions in the morning was financially ruined by afternoon. History remembers this day as Silver Thursday, and the lesson most people took from it was silver is dangerous, too volatile, too manipulable. Stay away. But that's the wrong lesson, and I'll tell you what the right lesson is in just a moment, because first, If you're watching this and you're wondering how to protect your hard-earned retirement savings from exactly the kind of monetary instability we're living through right now, I put together a free guide that covers the saving strategies thousands of American retirees are already using. The link is in the description below. Worth taking a look if that's relevant to your situation. Now, back to 1980 and what it means for today. The right lesson from 1980 is not that silver is dangerous. The right lesson is this: when the gap between paper silver and physical silver becomes too extreme, the market breaks. When more silver is being promised on paper than actually exists in the world, and when real physical demand for the actual metal begins pressing against that fiction, something has to give. Either prices have to adjust violently upward to ration the real metal, or the people running the game change the rules. The Hunt brothers discovered this the hard way. But here is what is profoundly, dramatically different about what's happening in the silver market today, and why the parallel to 1980 runs even deeper than most people realize. In 1980, the squeeze was manufactured. It was two wealthy brothers deliberately trying to corner a market. The price spike was real, but the underlying driver was speculative accumulation, not genuine demand for the metal itself. When the COMEX changed its rules and killed the speculative position, the price collapsed because the fundamental demand for silver at $50 an ounce wasn't really there yet. Today is completely different. Today, the demand for physical silver is structural. It is baked into the global economy in ways that cannot be regulated away, cannot be changed by COMEX rule tweaks, and cannot be stopped by governments declaring trading limits. Because today's demand for silver is coming from solar panels, from electric vehicles, from artificial intelligence data centers, from advanced medical technology, from the semiconductor chips that power every device you own. Let me give you some numbers that will put this in perspective. Every single solar panel produced in the world uses silver, not a symbolic amount, a meaningful, irreplaceable amount. The photovoltaic cells in solar panels require silver paste as an electrical conductor, and there is no adequate substitute that performs as well at scale. Global solar installation capacity has been growing at a rate that the industry itself struggled to predict even 5 years ago. The energy transition is not slowing down, it's accelerating. And every gigawatt of solar capacity that comes online requires real physical silver. Then there are electric vehicles. Every EV contains multiple times the silver content of a traditional internal combustion engine vehicle. The charging infrastructure, every EV charging station, requires silver in its components. As the global vehicle fleet transitions toward electrification, silver demand from this sector alone is projected to grow by orders of magnitude over the coming decade. And now, add artificial intelligence. The data centers that run the world's AI systems, the massive server farms that power everything from large language models to autonomous systems, require advanced semiconductor chips. Those chips require silver. The build-out of AI infrastructure globally is one of the fastest capital deployment stories in human history, and silver is a required input. So here's the situation we're actually in. Silver supply comes primarily from mining, and the largest producing nations are Mexico, Peru, and China. Global silver mine production has been essentially flat for years. It takes a decade or more to bring a new major silver mine into production. You cannot snap your fingers and create new supply. Meanwhile, industrial demand has been outpacing supply for consecutive years, drawing down the above-ground stockpiles of physical silver that took decades to accumulate. This is what analysts mean when they talk about a structural silver deficit. It's not a rumor, it's not a projection. The Silver Institute and other industry tracking organizations have documented multi-year consecutive supply deficits, meaning the world is consuming more silver than it is pulling out of the ground. Every year, the gap is being closed by drawing down existing inventories, and those inventories are finite. Now let's talk about the paper market, because this is where the 1980 parallel becomes absolutely chilling. On the COMEX, the ratio of paper silver contracts to registered physical silver available for delivery has been at extreme historical levels. What this means in plain English is that there are many more promises to deliver silver than there is actual silver sitting in the vaults to fulfill those promises. This works fine. It has always worked fine, as long as most contract holders are content to receive cash settlement rather than demanding physical metal. But what happens when industrial users, who actually need the metal, start demanding delivery? What happens when the companies building solar farms and AI infrastructure and electric vehicles show up at the exchange and say, "We don't want your paper settlement. We need the actual silver to manufacture our products"? That is when the Hunt brothers scenario replays itself, not because of two rich Texans in Dallas, but because of the entire industrial base of the global economy simultaneously competing for a metal that isn't there in the quantities the paper market claims it is. Silver hit $121 an ounce earlier this year. That was not an accident. That was the market beginning to price in what was coming. And then the pullback happened, driven by a strong jobs report, by the Fed signaling it may raise rates again before year end, by geopolitical tensions temporarily easing between Iran and Israel. Silver came back down to the $67, $68 range we're in right now. And here is exactly what I want you to understand about that pullback, because this is the most important thing I'll say in this entire video. In 1980, before the final blow-off move that took silver from $10 to $50, there were multiple consolidations, multiple moments where the price pulled back and the bears declared victory. Each one of those pullbacks was a trap for the people who sold and a gift for the people who understood what was really building underneath. The gold to silver ratio right now sits at approximately 63 to 1. That means it takes roughly 63 ounces of silver to buy 1 ounce of gold. Historically, throughout most of recorded human monetary history, that ratio has been much tighter, often in the range of 15 or 16 to 1, reflecting the actual geological abundance of silver relative to gold in the Earth's crust. Even in recent decades, when silver has been undervalued, the ratio has averaged closer to 50 to 1 or 60 to 1. At 63 to 1, silver is historically cheap relative to gold, and gold itself is sitting at over $4,300 an ounce, 30% higher than a year ago, having reached an all-time high above $5,600 just months ago. Think about what the math tells you. If gold holds at current levels and the gold to silver ratio simply returns to its 50-year historical average, silver needs to be significantly higher than it is today. If the ratio moves toward 40 to 1, which is not an extreme or exceptional historical reading, just a moderate reversion, you're looking at silver prices that are multiples of where we are right now. And if the industrial demand story I've described plays out the way the supply and demand fundamentals suggest it should, the ratio could compress far more dramatically than that. Now, this isn't just an academic exercise in historical ratios. The central banks of the world understand that something has shifted in the global monetary architecture. We're watching nations across the BRICS coalition, Brazil, Russia, India, China, South Africa, actively working to reduce their dependence on the US dollar as the world's reserve currency. Central bank gold purchases have been running at some of the highest levels in decades. China's official gold reserves have been growing steadily. Russia has been accumulating. Countries from Poland to India to Turkey have been adding to their gold positions at a pace that suggests institutional conviction, not casual portfolio rebalancing. What central banks understand, what they always understand before the rest of us, is that when confidence in paper currencies comes under pressure, hard assets absorb the flight capital. Gold moves first because it has a longer track record as a monetary metal and deeper institutional recognition. But silver follows gold. It always has. And when silver moves, it tends to move faster, further, and more violently than gold, because the market is smaller, the industrial demand is more concentrated, and the paper-to-physical leverage is more extreme. The inflation data tells another part of this story. U.S. inflation came in at 3.8% as of the most recent reading. The Federal Reserve's funds rate sits at 3.75%, barely above the inflation rate. Real interest rates, meaning the Fed's rate minus actual inflation, are essentially at zero or slightly negative when you use honest inflation measures, rather than the official figures that habitually undercount what real people experience in their day-to-day lives. Historically, when real interest rates are negative or near zero, precious metals have outperformed almost every other asset class. That's not a belief. It's a 40-year statistical pattern. And the geopolitical backdrop isn't calming down. It's intensifying. The ongoing conflict involving Iran and Israel, the near closure of the Strait of Hormuz disrupting Persian Gulf energy shipments, the elevated oil prices feeding back into inflation, all of this is exactly the kind of environment where silver and gold have historically served as the insurance policy that retirees and savers wish they had purchased before they needed it. Before I continue with where the price is going from here, I want to quickly mention something for those of you who have $100,000 or more in a retirement account, a 401k, an IRA, a pension that's been rolled over. There is a way to hold physical gold and silver inside a tax-advantaged retirement account structure. It's called a gold IRA, and it's completely legitimate under IRS rules. The reason more people don't do it is simply that most financial advisors aren't incentivized to tell you about it. They make their money keeping your savings in the paper assets they manage. If you want to understand how this works, how to move retirement assets into physical precious metals without triggering a tax penalty, and how thousands of American retirees are using this as a hedge against everything we've been talking about, inflation, currency debasement, geopolitical risk, market instability, the information is in the description below. It's worth understanding before you need it. Okay, back to where silver is heading. Let's talk about the COMEX mechanics more specifically, because this is where the 1980 parallel gets razor sharp. When the Hunt brothers were building their position, they were doing something that the COMEX was not designed to accommodate at scale, demanding physical delivery. The exchange was built on the assumption that most traders would settle in cash. When that assumption was violated, the system couldn't handle it. Today, you don't need two Texas billionaires to break that assumption. You just need a handful of major industrial corporations whose manufacturing lines cannot function without silver to decide they want to ensure supply security by taking delivery. A solar panel manufacturer that needs $1 billion worth of silver to fulfill contracts for the next 2 years of construction doesn't care about the spot price volatility. They care about having the metal. A semiconductor fabricator that needs silver for chip production doesn't have the option of accepting a cash settlement. They need the silver. When industrial users start behaving like the Hunt brothers, demanding physical delivery to secure supply, the paper market's vulnerabilities become everybody's problem simultaneously. And the COMEX doesn't have the same ability to simply change the rules this time around, because the industrial users aren't speculators. They're companies with legitimate, documented, economically essential need for the physical metal. Telling them they can only close positions and not take delivery would be tantamount to shutting down critical manufacturing sectors of the global economy. This is the scenario that silver analysts who study the microstructure of the market have been warning about for years. It's not a conspiracy theory. It's a logical analysis of what happens when structural supply deficits persist long enough, paper leverage grows extreme enough, and industrial demand becomes urgent enough that the fiction of the paper market collides with the reality of the physical market. And here is the final piece of the puzzle that I think most people watching this have never considered. In 1980, when silver spiked to $50, the public didn't really participate. The move was driven almost entirely by the Hunt brothers and a relatively small number of institutional traders who understood the commodity markets. Ordinary retail investors didn't have easy access to silver. There were no ETFs. There were no online brokers with one-click silver purchases. There were no apps where you could buy fractional silver bars in 5 seconds. Today, the retail investor base for precious metals is orders of magnitude larger, more informed, and more connected. When silver begins its next serious move, when the headlines start running and the price starts making new highs, the wave of retail buying that will pour into the market will be unlike anything that happened in 1979 and 1980. The Hunt brothers created that move essentially alone. The next move will have the Hunts, plus millions of individual investors, plus industrial corporations, plus institutional funds, plus central banks, all simultaneously pressing against a market that is already structurally short of physical supply. That is not a scenario that resolves itself gently. That is not a scenario where prices drift gradually higher over a period of years. That is a scenario for a violent, rapid, disorderly repricing event, which is exactly what happened in 1980. Which is exactly why the title of this video says what it says. Now, the pullback we're in right now, $67, $68, doesn't change any of this. If anything, it's the classic pattern before a major move. The price went parabolic to over $120 earlier this year. The weak hands panicked and sold. The paper traders who are perpetually short silver breathed a sigh of relief. The mainstream financial press declared the metal's run over. This is precisely the environment in which real wealth is quietly transferred from those who don't understand what they're looking at to those who do. I've spent a lot of time in this video talking about silver's explosive upside potential, but I want to be honest with you about something, because I think you deserve honesty rather than just cheerleading. Nothing in markets is certain. Short-term price action can be brutal in either direction. If the Federal Reserve raises rates aggressively, if industrial demand somehow slows materially, if geopolitical tensions resolve more completely than they appear likely to, any of these things could weigh on silver in the short term. The $68 level could break lower before the next major light higher begins. But here's the thing. If you're watching this video and you're a retiree, or you're approaching retirement, or you're a saver who is genuinely worried about what the next 5 to 10 years looks like for your purchasing power, then you're not asking whether silver will hit a new all-time high next Tuesday. You're asking a different question. You're asking, given everything going on in the world, the inflation, the debt levels, the geopolitical instability, the de-dollarization trend, the structural supply deficits in real assets, what should my portfolio look like to protect what I've spent a lifetime building? And the answer to that question, when you look at history, when you look at what happened in every previous era of monetary stress, currency debasement, and geopolitical upheaval, is that physical precious metals have preserved wealth across thousands of years of human civilization, not paper promises backed by nothing, not the currency of governments that have a historical track record of inflating their way out of debt, not the stock prices of corporations that can be made worthless overnight by regulation, competition, or fraud. Real metal. Heavy, physical, nobody can print more of it metal. The 1980s silver story is a warning. It's a warning that markets can reprice with stunning violence when the conditions are right. It's a warning that the paper promises the financial establishment makes about the value of assets can be exposed as fiction without much notice. And it's a warning that the people who understand what's really happening before the crowd does are the ones who end up on the right side of history. I've laid out for you today the structural supply deficits, the industrial demand explosion, the paper to physical leverage in the COMEX, the gold to silver ratio's historical extremes, the central bank behavior, the inflationary backdrop, the geopolitical tinderbox, and the direct mechanical parallel to 1980 squeeze. All of those things are pointing in the same direction. The question isn't whether this is going to happen. The question is whether you're going to be positioned when it does. If you're serious about protecting your savings, if you have a meaningful retirement account and you want to understand exactly how physical precious metals can be integrated into your retirement strategy without triggering taxes, without penalties, and without handing your hard-earned savings to a paper market that may be facing a reckoning, then take one action before you close this video. Go to the description. There's a free guide down there that thousands of American retirees have already used to understand how to protect their wealth using strategies the mainstream financial press rarely talks about. And for those of you who made it all the way to the end of this video, I appreciate you. You're exactly the kind of serious, thoughtful person who actually takes the time to understand what's happening before making decisions. Because of that, I want to offer you something the guide alone doesn't include. If you check out the guide in the description and you mention that you watched this video all the way through, you'll get access to an exclusive one-on-one educational web conference, completely free, no obligation, where you can ask specific questions about your situation. This is available only to American retirees who have at least $100,000 in any retirement account, and it won't be available indefinitely. The 1980 silver story ended badly for the people who didn't see it coming. Make sure you're not in that group this time.